Hello investors, welcome to Simpli Stocks. Whenever new members join our Simpli Stocks community, they often share their portfolios with me for review. Till date, I have reviewed many portfolios, and these 5 mistakes I have noticed in almost all portfolios. I have also made these mistakes myself when I was new to the market, but from each of my mistakes, I learned something that helped me to minimize losses and maximize my performance. So today we will look at 5 biggest but very common investing mistakes that retail investors make, which prevent them from generating good performance. The first mistake that I have observed is that people focus too much on CMP or stock price. For example, they say things like, today the stock price went up by 2%, I'll buy tomorrow. Or today it went down by 2%, I will sell tomorrow. There are other versions of it too. I wanted to buy this business, but its price has gone up by 20%. Now I will wait for it to correct, then I will buy. Doing this only leads to regret, because you see, the market doesn't move according to your thinking. In this process, investors lose out on many good opportunities. If you say that you are a long-term investor, then these 5-10% movements don't even matter. The simple meaning of long-term is that if we find a good business in the next 2 to 3 years, we should aim to double or triple our investment and then exit. So when you are targeting 100 to 100% return type opportunities, tracking 2, 4, 5% price movements doesn't make any sense, first of all. Secondly, most of you are probably employed somewhere, or you might have your own business. You won't be sitting idle all day, I guess. There are far more important things in your life than the market. In such a scenario, saying, I'll keep tracking, if it falls, I will buy, when it reaches my buying price, I'll sell, all of this is practically impossible. Tomorrow, you will either forget this trade or something will come up and you'll get busy. Then either the opportunity will slip away, or if you had to sell something, your loss will keep increasing. And believe it or not, no one can predict market movements. If you are a trader, that's a different game. I'm not commenting there. I am a pure play investor. The simple rule of investing is that a business that performs well, whose results are good, will go up in the long term. If you are also an investor, your focus should be more on tracking results than on stock prices. The second biggest mistake, or we can also call it a bias, is that people sell their good picks and keep averaging their loss-making businesses. There is a good idiom for this: throwing good money after bad money. Understand it like this: if a business is performing poorly, let us say its sales are not growing, profit margins are falling, or it is facing some problems, its employees are leaving, or the company is going into losses. In such a scenario, the company's difficulties will only increase over time. Today there is one problem, tomorrow there will be another problem. There are problems, that's why its price is falling in the market. All big smart investors are exiting the business. But what do retail investors do? They act like heroes. They go and grab a hot iron. They keep averaging. But the company's stock won't magically go up, right? Yes Bank and Dream Folks are the two best examples of this. Their businesses faced difficulties, but people kept buying the dip. On the other hand, think of a company whose sales are increasing, profits are growing. That business will invest that money to set up a new manufacturing plant or open new stores. Basically, it will expand its business, so its sales and profits will continue to grow. In the long term, this is how the business will keep performing well. But what do people do when they see 30-40% profit? They immediately exit that business. And the reason is that people come into the market without a business mindset. Look at it this way: if Reliance made money between 2005 to 2010, it doesn't mean it didn't generate returns between 2010 to 2020. If a company's sales and profits keep increasing and the valuation is good, then its price will go up even further. Now moving on, third biggest mistake I have observed is that retail investors chase stocks from hyped or trending sectors. 1.5 to 2 years ago, this happened with railways, EV, defense, and PSU stocks. Everyone faced losses there. Now everyone has forgotten their past sins and is now chasing AI, semiconductor, and data center stocks. I often explain this point using example of iPhone. For example, iPhone 17 has just come out. You must be seeing how much craze is there in the market. So iPhone 17 is your trending sector here. Now imagine if I sell you iPhone for 50,000 rupees, you will immediately buy it. You know you are getting a steal deal. You can sell that 50,000 rupees iPhone to someone else easily for 1.5 to 2 lakh rupees. But if I sell you the same iPhone for 5 lakh rupees, you will call me crazy, right? The point here is that iPhone at 50,000 rupees is a good deal because there is a scope for profit. But the same iPhone at 5 lakh rupees is overvalued. Even if it is the latest edition, it is overvalued. And let us assume you bought it from me for 5 lakh rupees. Think about it. What are the chances that you will find someone else who will buy it from you for 10 lakh rupees. Practically none. The big risk with trending hyped sectors is that by the time retail investors enter, the valuations become unreasonable. So much storification is done and hype is created on YouTube, Instagram, and news that everyone stops talking about valuation, business model, or risk. If you look at this screenshot, you will see due to hype in semiconductors, even very small companies are trading at PE ratios of 100 to 150. At such high valuations, either these stocks will crash or in the next 3-4 years, they won't move much. Instead, invest where you understand the business model, where the valuation makes sense to you. Believe it or not, I have earned the most returns from very simple business models. If I tell you about my old multi-bagger business models, you will laugh. SML Isuzu makes school buses, AGI Greenpack makes glass bottles for alcohol and drugs, Sky Gold makes jewelry for companies like Kalyan and Malabad. You see how simple these business models are. You should understand where your money is going and what the valuation is. And I know I keep saying this again and again and you don't listen, but still, as a humble request, if you are liking this video so far, do give me a thumbs up. And yes, you can also subscribe to our channel Simply Stocks. For us, your likes and subscribes are the only motivation that keep us going. So do like this video and also subscribe to the channel. Let's come back to our discussion. The fourth mistake that I often see people make is that they do not pay attention to diversification while building their portfolios. In most of the portfolios, there are barely 50 to 20 stocks. Ideally, your portfolio should have at least 35 to 40 businesses. Secondly, even the 15-20 stocks that people do hold there are just for the namesake. What people usually do is that they put 20-30% of their total portfolio money into just one or two stocks. In fact, I have even seen portfolios where more than half of the money is invested in a single sector like EMS or railways. So you can see how extremely risky these portfolios are. If that sector faces any slowdown or problem, then half of the portfolio is gone. Or even if one or two of those stocks where 20-30% of the money is invested face trouble, your entire portfolio will suffer. And if you feel that having 35-45 stocks in a portfolio is a big number, then go and look at portfolios of ace investors. You will easily find 40 to 50 or even more stocks there. Now you tell me, those ace investors who do so much research, who personally meet management, even they prefer to stay this diversified. So how can you expect that your portfolio of 10-20 stocks will be safe and will also outperform in the long term? So the most ideal number that I have found is that a portfolio should have around 35 to 45 companies, and depending on whether the company is large or small, allocation should be done accordingly. For example, in a large cap business, I usually invest around 3 to 4% of my portfolio and 1 to 2% in any small cap. By giving such 2 to 3% allocations across different businesses, you will be able to build a very good diversified and safe portfolio. Now, related to this same topic of allocation, the fifth and last biggest mistake people make is in the greed of making quick money, they over-invest in penny stocks or microcap companies. These are such small businesses that anything can go wrong there at any time. So from a risk point of view, you simply cannot give them a large allocation. These stocks also face liquidity issues. If, for example, there is some fraud in the business or the results turn out poor, the stock will keep hitting lower circuits continuously and you won't even be able to sell it. By the time you get chance to sell it, the stock will already be 30 to 40% below your buying price and you will have to book that capital loss. So that's why whenever I invest in a penny stock, I start with just 0.5%, 1% allocation. Meaning if my total portfolio is of 10 lakh rupees, I would invest only 5 to 10,000 rupees in such a small business. Now, this might seem like a very small amount to you, but think of it this way. The whole point of a microcap business is to grow fast. If things go well, then this small size business will grow fast and my investment will automatically become 3 to 4 times in 2 to 3 years. That means even if you do excellent analysis, out of your best 5, hardly 1 or 2 penny stocks will actually perform. So you need to diversify by giving half 1% allocations, test 4 to 5 microcap businesses and see which ones perform well over time. Now, if you like this video, then do give me a thumbs up. Apart from that, you can also subscribe to our channel Simply Stocks. For us, your likes and subscribes are our only motivation so that we keep bringing such high quality research videos for you every week. So do like this video and yes, also subscribe to the channel. I'll see you in the next video. Happy investing.